Give us some sense of what the markets are thinking, because there was enough reason to really pause this week when you have increased COVID-19 cases throughout the South in particular. You've got some problems with China. Maybe there's not going to be a phase 2 deal. You've even got a Joe Biden and maybe a Democrat Senate. So why are the markets continuing to push up so relentlessly?
There's always things to worry about. In fact, we often use the expression that the markets climb the wall of worry. So the fact that there's more COVID incidents in the South and the West, and we actually are seeing fatalities go up, is definitely something to watch very carefully. But when we actually look at the turnaround in the economy, that's been quite dramatic. So we have gone from a steady decline, numbers looking pretty terrible on the unemployment insurance claims, the first-time claims being up like 6.8 million people at the peak, to now something like 1.3 million. So we're seeing a very big shift in the economy relative to what people were expecting. The data has surprised to the upside, whether we're looking at retail sales, whether we're looking at car sales, whether we're looking at mortgage applications, whether we're looking at the ISM manufacturing and non-manufacturing surveys, consumer confidence. So things are clearly improving, and the market is moving from pricing a very bad environment, to where some people even use the term depression, which we never used, to actually being more optimistic that maybe 2020 will be a year that's down about 5% plus or minus a little bit in terms of economic growth. And then we recover by about 5 or 6% in 2021. So our view is that this is not an irrational market. Equity markets are forward-looking, so they're looking at what earnings will look like in 2021. We're already in July. There's a sense that from some of the early reporters, those who reported at the end of May, that actually they have beaten expectations. And so there's some sense that that's going to be positive. And when we're looking at these numbers, we're saying we know that as long as people do follow the guidelines, which is a big if in terms of social distancing, in terms of wearing masks, we are going to have some prospects of therapies in later this year in the fall. We're not that optimistic about vaccines being broadly available at the end of this year. It's much more of a 2021 issue. But so overall, when we look at the numbers, we don't think the market is at outrageously high levels at all.
Sharmin, maybe the biggest headline about the markets this week was large cap tech. I mean, they're really big. The FANG stocks really drove this thing to a large degree. How broad is the increase in the markets, or how confident are the markets, or is it really just a relatively handful of companies that are driving an awful lot of this?
We actually look at a series of indicators. We do look at the advanced decline numbers. We're looking at percentage of stocks that are above versus below over the last, let's say, 10 days, 50 days, 30 days, what the moving averages are. We look at a broad range of market technicals as well. And there is some divergence. So if you're looking at growth stocks versus value stocks, if you're looking at the energy sector or financials, we actually don't think those are sectors that will drive the market, but it is not that narrow that is only the FANG stocks. The healthcare industry is actually doing very well. There are other sectors of the economy. So we think it's more broad-based than people actually acknowledge.
So Sharmin, you said immediately it's because the economy does seem to be coming back perhaps faster than we thought. Let me give you an alternative explanation, which is the Fed has really taken the rates down so terribly far, and it really makes there's almost no alternative. The yield is so much worse anywhere else, as opposed to the underlying fundamentals of the economy driving it. What about that?
When we think about equity markets and equity market valuations, we look at a couple of different components. So when we look at equities, we do look at the equity risk premium, meaning looking at equity valuations versus bond valuations. So there's no doubt that such low interest rates across the board do provide some support to the equity market. But we also think the equity market is not that expensive. When you look at equities in periods of low and stable inflation like we are in right now, and we expect to be in for the foreseeable future, equity valuations are consistently higher. So relative to that environment, we're maybe 10 to 15% overvalued. That is not enough to compel us to say clients should be underweight equities. We actually recommend clients be fully invested at their strategic asset allocation. So whatever the client's risk tolerance is, that is where we recommend our clients be. So our view is that this is actually a market that is trading on fundamentals. The underlying growth is actually real. It's not just driven by the low interest rates.
What about alternatives, Sharmin, to, for example, U.S. equities? And let me give you one specifically. People talk about gold or talk about bonds, things like that. What about European equities? Because if this really is a race about how to deal with the COVID-19, right now it looks like Europe's doing a better job of that than the United States.
You're quite right. You can look at all the mobility data from some of the more high-frequency sources of data, and you notice that Europe is in line with the U.S. in terms of the economy's reopening, and yet the huge spike that we have seen in the U.S. and, again, the South and the West with specific states, you're not seeing at all in Europe. And that is really a function of people not wearing masks, not following the social distancing guidelines. It's not because they have better fiscal stimulus. It's not because they have a better monetary policy. It's not because they have a better earnings outlook. In fact, if you think about what you just mentioned earlier in terms of technology stocks, information technology in aggregate is a much bigger part of the S&P 500 versus European stocks. So when we look at that, we actually at the margin do have a U.S. preeminence view. It's a view we've had now for over 10 years. When it comes to looking at European stocks, and that includes emerging market stocks as well, we do recognize that they're trading at a significant discount to their long-term averages, but we actually think that is justified. We think Europe will be much slower to grow. We think that when it comes to a coordinated policy, in terms of fiscal and monetary policy, it's been a little bit harder. We already know, for example, when people have questioned the ECB policy of buying bonds, whether it's legal or not legal, we don't have those issues with the Federal Reserve. And when it comes to fiscal policy, the U.S. has been much faster and much more aggressive. So when we combine the level of innovation, the role of technology, and these other policy factors in the U.S., we actually think that the U.S. is a better place to be than any overweight to Europe or emerging markets.